Right then, no fuffing about, no intros, straight in. Today, we're ripping into a book that's basically the Old Testament of investing.
Right.
Stocks for the Long Run by Professor Jeremy Siegel.
Mate, this book is a religion. Every financial advisor from here to New York has got it on their shelf.
Yeah?
It's the reason your dad tells you to just, bung your savings into an index fund and shut up.
The governor, they call him. So, for anyone who ain't been forced to read it, what's the gospel according to Saint Siegel?
Lay it on us. It's dead simple. Which is why people love it. He's got this one chart, this one killer chart that goes all the way back to 1802. It shows that if you put $1 in stocks back then, you'd have like millions.
Wow.
If you put it in gold, you'd have about £3.
Scoff.
So you'd have enough for a pint and a packet of crisps.
Nice.
Exactly. So the message is, stocks are king. They batter bonds, gold, cash, everything. Don't try and be clever.
Right.
Don't time the market. Just buy stocks and hold them forever. The long run.
1802 though, that's the bit that gets me. Were people even trading stocks? I thought they were still trading like tulips and spices.
Right?
That sounds like fantasy, building a whole theory on data from a time when Wall Street was just an actual wall.
You've hit the nail on the head, mate. That's the first massive crack in this whole church. It gives this feeling of solid 200-year-old wisdom.
Yeah.
But how good can that data really be?
So, let's get our sledgehammers out. Let's talk about the data. You've been digging into this. What's the dirt?
Right, so this is the juicy bit. The whole stocks always win thing feels true because we've seen it in our lifetimes, but Siegel's 200-year claim is what makes him a legend. The problem is, a proper data detective, this bloke Edward Macquarie, he went back to check his homework.
A data snitch. I like it.
He's the hero we need. Macquarie went into the archives, looked at the original newspapers and broker records from the 1800s, and he found that Siegel, well, he kind of fudged it.
Hold up.
Fudged it? You're telling me the Bible of investing is based on dodgy numbers? Big time. There were massive gaps in the data, especially on how much companies paid in dividends. So Siegel just, assumed. No. He basically said, well, it was probably about 6.4% and plugged that number in for decades. He guessed.
He guessed? That is absolutely outrageous. He's like a builder looking at a hole in a foundation and saying, yeah, just shove some newspaper in there, it'll be fine. So what did the real numbers say when Macquarie found them?
Well, the real numbers tell a completely different story. For massive stretches of time.
Okay.
For massive stretches of time, from 1802 to the middle of the 20th century, stocks and bonds were basically neck and neck. There were 30, 40, even 50-year periods where bonds actually beat stocks.
No way. So the whole idea of the equity risk premium, that you're always paid extra for the risk of owning stocks, is not a constant.
Right.
It comes and goes.
Exactly. It's not an iron law of physics, it's a weather pattern. The stocks always win story is really a post-World War II story.
Right.
It's an American century story. America smashes it globally, its companies take over the world, and the stock market goes on a 70-year bender. Siegel presents that as normal. It's not normal. It's a massive historical outlier.
That's a proper big short moment, innit? Finding the one flaw that everyone else has built their entire worldview on. So the book isn't stocks for the long run. It's stocks during the American Empire.
You've got it. And that brings up the next massive problem, survivorship bias. It's easy to say buy and hold works when you only look at the winning team. I mean, what if you were an investor in London in 1900? You were the centre of the world. But 2 world wars later, your market was decimated. What if you were in Japan in 1989 or Russia in 1917? Your long run was a straight line to zero.
Your portfolio got deleted. Game over. So, his advice is only guaranteed if you pick the one country that's going to rule the world for the next 100 years and you pick it in advance. Easy.
Simple as that. And even then, mate, the game has changed. Another critic, Rob Arnott, makes a brilliant point. He says the returns we've seen recently aren't the same as the old days. It's not just about companies growing and paying dividends.
What is it then?
It's hype. He calls it revaluation alpha. It just means PE ratios are expanding. People are willing to pay more and more for the same pound of earnings.
Ah.
It's a confidence game.
So that sounds like a bubble.
You're not buying a business. Yeah, you're buying a lottery ticket and hoping someone else will buy it off you for more. That's what a lot of the market has become. So you can't compare the solid industrial dividend-paying stocks of 1950 to a tech company today that's priced at 100 times its sales and has never made a profit.
Right.
It's apples and oranges. All right, what about the man himself? Siegel's still on TV, still the big governor. Is he admitting any of this? Has he updated his views? Nah, he's a permabull. He's the eternal optimist. He was correctly bullish in 2023 and 2024, to be fair to him.
Okay.
But he's a pathologically bullish. He was calling for the Fed to pivot and cut rates way too early. If you'd followed his short-term calls, you'd have been fighting the Fed for 2 years.
So he's a one-trick pony. His trick is buy stocks.
Yep.
And in a bull market, that makes him look like a genius.
That's the game. The book is a comfort blanket. It tells you a simple, soothing story.
Right.
It papers over all the cracks, all the risk, all the messiness.
So, final verdict. We're putting stocks for the long run in the big short club sin bin. Is it a complete load of rubbish?
It's not complete rubbish. It's a history book. And for the period from 1950 to now, in the US, he was spot on. If you followed his advice, you did great. But the danger is believing it's a timeless, universal law. It's not.
Right.
It's a regional weather report from the 20th century that he's trying to sell as a global climate model for all time.
And the first 120 years of it might as well be from a fantasy novel. So the real lesson here isn't buy and hold.
The real lesson is question the narrative.
Yes, especially when it's built on one pretty chart. Check the receipts. Always check the receipts. So, for the bloke listening to this on his way to work thinking about his pension, what's the move? If Siegel's map is out of date, where are we going? You probably still need to own stocks, but you need to be realistic. That 7% real return Siegel talks about, it's not a birthright. It's a historical anomaly. The long run might be much longer than your career, and the returns might be flat. You have to be prepared for the idea that the next 50 years might look more like the 19th century than the 20th. Grim. So you're saying we could be doing everything right and still get nowhere because we were born in the wrong era?
It's a real possibility. Welcome to the game. It's about managing risk, not believing in fairy tales.
Heavy. All right, let's leave the people with something to chew on. A slight pause, tone shifts. Siegel's book gave millions of people a simple story to believe in, and for many, it worked. But it looks like that story is built on a shaky foundation. So here's a question we'd like you to think about. In a world without simple guaranteed rules, where the old maps are wrong, what do you trust? Who do you listen to? And how do you build a strategy when you know that the long run might never show up?